The market is currently closed. As of the closing bell on Friday, October 31st, 2025, Berkshire Hathaway Class B, ticker BRK.B, settled at $477.89 per share. This was a modest slide on the day, down about 63 cents or 0.13% in a relatively tight trading range. But that single day's quiet drift is the perfect mask for the massive story that just broke, a story that fundamentally reframes what this company is and what it's telling us about the entire market. The expectation, especially after the just-released third-quarter earnings, is one of a blowout. The headline numbers look fantastic. A 17% jump in net profit, a 34% surge in operating earnings. It looks like the fortress is stronger than ever. But the reality is far more complicated and, frankly, far more interesting. The real story isn't the profit, it's the pile of cash. That pile has now swelled to an all-time mind-boggling record of $381.7 billion. This isn't just a side note, it's the entire thesis. That cash hoard isn't a sign of victory, it's a statement of profound market skepticism, an active decision of inaction by the most watched investor in history. Let's establish the common ground. For decades, investors have flocked to Berkshire Hathaway. It's the ultimate buy and hold stock, a proxy for American economic strength. People using Fidelity or managing a Schwab Intelligent portfolio see BRK.B as a cornerstone, a diversified holding company that gives you exposure to insurance, railroads, utilities, and a blue-chip stock portfolio all in one. It's the antithesis to the frantic trading you see in Tesla stock or the daily volatility of Nvidia stock. The general belief is that you buy Berkshire to sleep well at night, trusting that Warren Buffett and his team are prudently allocating capital for the long haul. You check your Fidelity mobile app or your individual brokerage account, see it there, and feel secure. This belief was only strengthened by the Q3 numbers that just hit the wires. Operating profit hit $13.49 billion, smashing analyst estimates. The insurance businesses in particular had a stellar quarter, with net underwriting earnings soaring to $2.4 billion, a massive reversal from the $750 million gain in the same period last year. It looks like a perfectly run machine. Now, let's challenge that narrative. The reality is that this blowout quarter reveals significant cracks and a core tension that the market is just beginning to price in. First, that incredible insurance profit wasn't just due to brilliant management. It was largely thanks to a quiet hurricane season. The reinsurance arm, which takes on risk from other insurers, swung from a loss last year to a $1.1 billion gain. That's a function of good luck and favorable weather as much as it is underwriting skill. At the same time, GEICO, the division most people know, actually saw its pre-tax underwriting profit slip by 13%. Why? Because it's being forced to cut its rates to win back market share it lost to competitors. That is a direct hit to margins. Furthermore, the massive utilities and energy division, Berkshire Hathaway Energy, saw its earnings fall almost 9% to $1.49 billion. This is not the picture of a fortress firing on all cylinders. It's a picture of a company whose core operating businesses are facing real headwinds, masked by a lucky quarter for insurance and massive interest income from that cash pile. The company is earning over $20 billion a year, risk-free, just from parking that $381.7 billion in short-term T-bills yielding over 5.4%. Berkshire Hathaway has, in effect, become part conglomerate, part colossal money market fund. This brings us to the stock's recent movement, which tells the true story of market doubt. Year-to-date, Berkshire B shares are up about 8.6%. That sounds okay until you compare it to the S&P 500, which is up over 16% in the same period. Berkshire is lagging significantly. Why? A huge part of that underperformance is a direct consequence of a mistake by Buffett himself. Earlier this year, he sold a massive 69% of Berkshire's stake in Apple stock. Since that sale, Apple stock has surged over 50%. That single decision, a decision to trim what he called his best business, has cost shareholders billions of upside and is a primary driver of this lag. This is the expectation-reality gap in action. Investors expect infallible capital allocation. The reality is that even the best get it wrong, and this time it was a costly one. This lag is also being driven by a rare underperform rating, essentially a sell recommendation from analysts at Keith, Brewett, and Woods. They are pointing to the exact issues we just discussed: the succession from Warren Buffett to Greg Abel, who is set to take over as CEO in January, the margin pressure at GEICO, and potential headwinds for the BNSF railroad from global trade uncertainty. The trading volume on the stock hasn't been panicked, but it's been heavy, reflecting a reevaluation of the company's future. While investors on the Robinhood app might be buying fractional shares of Tesla stock, hoping for a 10x, institutional investors using sophisticated platforms like Interactive Brokers are recalibrating their BRK.B models, and many don't like what they see. So, what does this company actually do? It's crucial to understand it's not just a stock portfolio like one of the Fidelity mutual funds. It's two giant operations. First, there's the collection of wholly owned businesses. This includes massive names like the BNSF Railroad, which is a barometer for the entire U.S. economy, Berkshire Hathaway Energy, a sprawling utility giant, and the entire insurance wing, GEICO, National Indemnity, General Re. It also owns dozens of smaller companies, from See's Candies to Clayton Homes. These businesses are supposed to be the engine, throwing off stable cash flow. The second part is the famous stock portfolio, which is managed like an in-house investment fund. This is where you'll find the massive remaining position in Apple stock, plus huge stakes in Bank of America, Coca-Cola, and American Express. The insurance float, premiums collected before claims are paid, is what historically provided the capital for these stock investments. But the Q3 report showed Berkshire was a net seller of stocks to the tune of $6.1 billion. And for the fifth quarter in a row, the company did not buy back its own shares. This is the most telling data point of all. Buffett and his lieutenants, Greg Abel and Ajit Jain, looked at the entire market, looked at their own stock, and decided that nothing was cheap enough to buy. They would rather earn 5.4% from the U.S. Treasury. This leads us to the future outlook, which is defined by two things: the cash and the succession. The bull case is simple. A market correction happens, and Berkshire, with its $381.7 billion war chest, finally goes elephant hunting. They could buy a company the size of FedEx or General Motors outright, with cash to spare. In that scenario, the cash pile transforms from a boat anchor into a rocket launcher. The other catalyst is the continued quiet compounding of the operating businesses, assuming they can navigate their current challenges. But the risks are now more pronounced than ever. The primary risk is the transition. Greg Abel is a world-class operator, but he is not Warren Buffett. The Buffett premium that the stock has enjoyed for decades is evaporating, and it's unclear if Abel's leadership, which will be more focused on operations than stock picking, can command the same market respect. This is a huge concern for anyone looking at online investment for the long term. Many investing sites and services like SoFi Invest still list Berkshire as a top safe pick, but the very nature of the company is about to change. The second major risk is the sheer law of large numbers. It is incredibly difficult to grow a trillion-dollar company at a high rate. The company is also facing specific litigation risks, particularly at its Pacificorp subsidiary, related to wildfire damage, which could result in billions in liabilities. And there's the irony of its own success. The company is so big that it faces regulatory scrutiny as a systemically important financial institution, which could tie its hands. For the individual investor doing self-investing, the question is whether Berkshire is still the same company they invested in. It has underperformed Nvidia stock, Apple stock, and the broader market. Its management just told you, by their actions, that they believe stocks are overvalued and that cash is the safest place to be. Speaking of that cash pile, what elephant do you think Berkshire should buy? Comment below with the company you think Buffett or Abel should acquire next. It's a critical question for anyone analyzing the stock. Whether you are building a portfolio on SoFi or engaging in active online investing through a Fidelity brokerage account, the Berkshire of 2026 will not be the Berkshire of the last 50 years. The strategy of Fidelity Wealth Management